$12,000 in tax. Not for buying the wrong house, for buying the right house with a closing date that slipped 4 months past a deadline CRA never announced and her builder never mentioned. This is Grace. She's 31, a graphic designer in Hamilton. She spent 3 years building her RRSP to $34,000, every dollar earmarked for her first home. She found a townhouse in a new development, made an offer, and withdrew the full $34,000 under the home buyer's plan. She felt like she'd played it perfectly. Then, her builder pushed the closing date back 6 months. The home buyer's plan lets you withdraw up to $60,000 from your RRSP tax-free to buy or build a qualifying first home, $120,000 for a couple where both partners qualify. Grace used it correctly. The withdrawal was approved, the money was hers. But there's a rule buried in the conditions that most first-time buyers never read. You must acquire the qualifying home, meaning the deal closes and title transfers, by October 1 of the year after your withdrawal. Withdraw in 1 year, and the clock starts. October 1 of the following year is the wall. Miss it, and the CRA adds the entire withdrawal to your taxable income for the year you took the money out. There is no extension for builder delays, no hardship provision for financing issues, no appeal for bad timing. Grace's builder pushed her closing from June of 1 year to February of the next, 4 months past October 1. That was all it took. $34,000 of taxable income on her return. At her marginal rate, the bill came to roughly $12,000. No new home, just a tax bill the size of a used car. There's a second trap for buyers who want to top up their RRSP before withdrawing. Any funds you contribute must sit in your RRSP for at least 90 days before you can withdraw them under the HBP. Contribute $10,000 and withdraw it 60 days later, and CRA denies the deduction. The $10,000 still counts toward your HBP withdrawal. You still repay it over 15 years. You just don't get the tax deduction. At a 33% marginal rate, that's $3,300 lost for a timing mistake measured in weeks. There is still a rescue path for buyers who discover the problem in time. If you repay the full HBP withdrawal back to your RRSP by December 31 of the second year after the withdrawal year, the CRA treats the withdrawal as if it never happened. No income inclusion. Grace caught her delay early enough. She repaid the $34,000 before year-end, avoided the $12,000 tax bill entirely, and withdrew again the following year when the home actually closed. Same house, no surprise. If you're planning an HBP withdrawal or have already made one, 3 things to verify. First, confirm your closing date lands before October 1 of the year after your withdrawal. Write both dates side by side. If your closing is uncomfortably close to that line, especially in a new build where delays are routine, talk to your accountant before the delay is confirmed, not after. Second, count 90 days backward from your planned withdrawal date. Every dollar you intend to withdraw must have been sitting in your RRSP for at least 90 days. Contributions made inside that window don't qualify for the deduction, even if the HBP withdrawal itself is valid. Third, verify you qualify as a first-time buyer before withdrawing. The HBP definition looks back 4 full calendar years. If you owned and lived in a home in that window, you don't qualify, and a withdrawal made anyway becomes fully taxable income. This catches previously divorced homeowners, partners who owned in a prior relationship, and anyone who sold within the lookback window. CRA does not send a reminder when the October 1 deadline approaches. Builders don't include it in purchase agreements. The rule exists, the deadline is firm, and the consequences of missing it arrive the following spring with no warning. Grace repaid and recovered. Not everyone discovers the problem in time.